We are Cell Company.
Cell phones, mobile users, and mobile devices is a very important part of our lives today. Communications in cell phones is made easy by us. We stand by whatever it takes to make international communication effective and efficient. We are a global team, 140 countries worldwide, with our headquarters in the U.S., dedicated to delivering excellence in the world of international communication. Our company is top industry player, operating in the intersection of affordable and accessible international communications and data improvement by providing a viable solution that facilitates not only better communication for millions of people around the world, but also efficiency of communications for millions of people around the world. Yes, we are recognized and valued and defined by our international mobile service of providing unlimited data packages, family data packages, quick SIM replacement cards. It gets better, people. Different innovative programs like Cell Premium, Cell Gold, Cell Silver, and phone number consistency and travel and international GPS, even in third world countries.
As a company, we would not have our success without accounting, and we are rooted in the framework that giving back to express our appreciation for accounting. We have generated a web series and an educational workshop to inspire others to embrace the art, language, and operations that is accounting.
Yes.
Our team is committed to expansion, shaping sustainable international communications for the future, and continuous research and development. So join us as we celebrate accounting. Let's do business together.
Hi guys, my name is Lene and I'm step 1 of analysis of the business transactions. So there's a few things that you should know. Step 1, financial transactions start off the 9-step process. Step 2, transactions include activities that involve exchange of company's assets, whether that's sale and return or just basically anything that you do with the company. Step 3, you must know which accounts have a normal debit balance and a normal credit balance. Over here I listed the debit balances are assets and the credit balances are liabilities and equity accounts. Okay, and step 4, all transactions must include a date, a credit, debit balance, and the amount. So here is the transaction we use. On January 15th, Cell Corporation paid rent for the month and it was in the amount of $1,300.
Okay, good morning class. Today we will be learning step 2 of the accounting cycle, which is posting into the General Journal. So posting to the General Journal is just a basic way to keep records of every transaction that goes on within the company. So for the example of today, we have on January 25th, Cell billed client for completed work for $3,820. So you write the date first, and then you write the first account, which will be debit, which is accounts receivable, and you put it under the debit column, which is $3,820, and then you credit service revenue for $3,820. Okay, step 3 of the accounting cycle deals with the T accounts. T accounts are used to keep a measure of the debits and credits during each account. So the left side is for the debit side and the right side is for the credit side. You have to know which accounts are a normal debit balance and normal credit balance. So for example, we're going to use the same one that we used for the General Journal in the previous step, accounts receivable. We debited accounts receivable for $3,820, so we write that in the debit side of the column, which is on the left side. Afterwards, we carry that same amount down to the total, which is remaining $3,820. For service revenue, that has a normal credit balance, so we're going to write the $3,800 on the credit side, and we're going to carry it down to the total, which is $3,820.
Hello y'all, my name is Mariana Vizquera and I am going to be teaching you the step 3, which is to post to ledger accounts. So before, when we had our journal entries, we have a general journal, which we just post all of our journal entries. So for this example, we have a February 1st cash for $15,000 and common stock, which is CS, for $15,000. So on the general journal, we would just keep posting all of our journal entries with their date, the accounts, and the debit and credit. So the same thing is done for the general ledger, but we break it up into subsidiary ledgers. So this one is just cash. So all of the journal entries that we had over here for cash, we would all sum them up over here. So this is the same February 1st, 15,000 debit. And then we would move on to all the different accounts we have, accounts receivable, notes receivable, everything else. So this is the common stock, the second part of the entry, which is 15,000 credit balance. All right, so for step 4, we're going to be preparing our trial balance. So we have all of our journal entries in a general journal and our general ledger. So we use all of these accounts and we list them out. Cash, building, machinery, any of our liabilities, which is account receivable, or accounts payable or notes payable, and then any of our equity like common stock or dividends. So we're going to list it out, and we are going to put it on the debit or credit side. So cash is a 15,000 debit we had for our February 1st example, and then the common stock we have a 15,000 credit. So at the end, you're going to total it up, and you're going to make sure that at the end of the unadjusted trial balance, that both debit and credit balances are the same, which they are 15,000.
Hi, my name is Caitlin Canty, and this is episode 5, and I'll be teaching the adjusted entries. So for the adjusted entries, this is where journal entries are made at the end of an accounting cycle to update certain revenue and expense accounts. So because we're doing accrual-based accounting, we record revenues when earned and expenses when used. There are 4 types of adjustments: prepaid expense, unearned revenue, accrued expense, and accrued revenue. So for example, since we haven't been paid yet, we're going to do salary expense for $3,000 and credit salaries payable to $3,000.
Hey, it's Tatiana here, episode 6 of our web series. I'll be going over the prepared adjusted trial balance and the prepared financial statements. So for the prepared adjusted trial balance, we have our unadjusted trial balance and our adjustments to make the adjusted trial balance. The reason why we prepare an adjusted trial balance is to update for accuracy of our company's records for any adjustments that may happen over the course of the annual report. For the prepared financial statements, we have 3 types of those. We have the income statement, the statement of retained earnings, and the balance sheet. For the income statement, we get our revenue minus our expenses to get our net income. Our net income is important to have because we need it for the next step for the statement of retained earnings. But going back to here, the income statement represents the period of time. For the statement of retained earnings, we have our beginning retained earnings plus our net income minus our dividends and the ending retained earnings. Then for the balance sheet, we have the accounting equation, which consists of the assets equals liabilities plus equity. The assets is what we own, liabilities is what we owe, and equity is the owner's claim on assets. So in this episode, I covered the prepared adjusted trial balance and prepared financial statements.
Hey guys, I'm Nicole here with the web series episode 8. I'm doing closing entries. So today we're going to talk about temporary, how temporary, also known as nominal accounts, include income, expense, withdrawal accounts. They are closed to prepare for the next accounting period and is measured periodically. It's measured periodically, closed to summary accounts, then their appropriate capital account. This also pertains to only temporary accounts. Episode 9 is post-closing trial balance, which we're going to talk about permanent accounts. Permanent accounts, also known as real accounts, include assets, liabilities, common stock, and retained earnings. They're prepared to determine the balance between debits and credits balances, and after the closing entries are made. This pertains to only real accounts.